Picture the first human who ever traded a perfectly good stone axe for a shinier one. The old axe still chopped wood just fine. The new one just looked better. That trade felt smart at the time, and honestly, it's still happening every day in car dealership parking lots. You walk onto a lot, you see a car with no scratches, no smell of someone else's takeout, a dashboard that still lights up like a spaceship, and some very old part of your brain sends a simple message. Newer is better. Shinier is safer. And something is best when nobody else has touched it first. That instinct kept a caveman alive when it came to picking fruit or firewood. It works very differently when it comes to buying a car, and almost nobody stops to ask why. So let's ask why. Because underneath the shiny showroom lights, a car isn't really something that keeps its value like a house or gold might. It's a machine that starts losing value the moment you drive it off the lot. And the whole used versus new decision really comes down to one question your gut instinct was never built to answer. Who loses that value first? And how much of that loss are you willing to take on yourself? Let's start with the part almost everyone can agree on. The second a brand new car is driven off the lot, it usually loses around 20% of its price. Not over a year, instantly. That first-year loss is often somewhere between 20 and 30% of what you paid. And by the time the car is 5 years old, it has often lost around 60% of its original value. On a $45,000 new car, that's not just a number on paper. That's about $27,000 gone in 5 years, whether you drove it 5,000 miles or 50,000. Here's the part that surprises people. That drop in value is steepest right at the beginning, and then it starts to level off. That means someone who buys the same car used a few years later is basically stepping in after the biggest drop has already happened. They're getting the same car, often the same engine, sometimes even leftover warranty coverage, at a price that already reflects that big early loss, a loss the very first owner had to absorb, not them. Someone has to pay for that new car feeling. It's just usually not the person who enjoys the car the longest. So why does a brand new car lose so much value the moment it's driven away, when nothing about the car has actually changed? Part of it is simple paperwork. Once a car has an owner's name on the title, it can never be sold as new again. And that one word, new, carries a price tag all its own that has nothing to do with how well the car runs. Part of it is that car companies keep making more of this year's model, which instantly makes last year's version less rare, and rare things tend to hold their price better. And part of it is just human psychology. Buyers quietly discount anything that's been owned before, even if it only had one careful owner and full paperwork to prove it, because our brains still treat "someone else had this first" as a mark against it. This is where the real trade-off shows up. Buying new means paying full price during the steepest part of that value drop, in exchange for a completely clean history, the newest safety features, and a warranty that covers almost everything for the first several years. Buying used means stepping in after that steep drop has already happened, in exchange for taking on someone else's unknown driving habits, a shorter or already expired warranty, and fewer choices in color or trim. Neither choice is wrong. But most buyers don't realize they're choosing between two very different bets, because the price tag makes it look like they're simply choosing between two prices on the same thing. Now let's talk about what actually shows up in your monthly bill, because this is where used is always cheaper starts to get more complicated. A loan on a new car usually comes with a lower interest rate, often somewhere around 6% to 8% for a buyer with decent credit. A loan on a used car for that same buyer is usually higher, often 9% to 11% or more, because lenders see more risk in a car whose condition they can't fully verify. Add that higher interest rate to a lower purchase price, and the gap between the two monthly payments often shrinks more than people expect, sometimes enough that a slightly older, certified used car ends up costing nearly the same each month as a smaller, brand new one. Then there's how long the loan lasts, and this is where gut instinct gets outsmarted by simple math. To keep the monthly payment feeling affordable, more and more new car buyers are stretching their loans out to 6 or even 7 years. That often means they're still making payments on the car long after the warranty has run out, and the resale value has already dropped sharply. There's actually a specific term for someone who owes more on their car loan than the car is currently worth. It's called being underwater on the loan. And that's not bad luck. It's a predictable result anytime the loan lasts longer than the car keeps its value. Insurance quietly follows the same pattern most people don't expect. A new car usually costs more to insure than an older used one, not because it breaks down more, but because if it's stolen or totaled, the insurance company has to pay to replace its full value. In other words, insurance companies mostly care about what the car is worth today, not how new it is. A 3 or 4-year-old version of the exact same model can come with a noticeably lower insurance bill, simply because there's less dollar value riding behind the windshield. So where does the used car actually cost you more? Because it's not free of downsides either. Once the original manufacturer's warranty runs out, usually somewhere between 3 and 5 years, or after a certain number of miles, whichever comes first, every repair bill becomes your problem instead of the car maker's. This is exactly the gap that certified pre-owned programs were created to fill. A certified used car has usually passed a detailed inspection and comes with an extended warranty added back on, at a higher price than a plain used car, but usually still cheaper than new. Think of it as the middle option, built for people who want someone else to have already taken the big early hit in value without fully giving up the safety net a warranty provides. Repair and maintenance costs are where the two paths really start to look different, and it's easy to underestimate this. A new car's first few years are famously cheap to maintain. Oil changes, tires, not much else, because nothing has had time to wear out yet. A used car, especially one bought right as its warranty is ending, can hit you with exactly the kind of repairs a new car buyer never has to think about yet. Brakes, suspension parts, or a transmission that's already logged real miles under someone else's driving habits you can't fully know. That's the real risk hiding inside buying used, and it is a real one. But it's also a risk you can measure ahead of time. The same way getting a home inspected before buying tells you what you're really getting into with an older house instead of new construction. Now put the full 5-year picture side by side, because this is where gut feeling and actual math really disagree. Buy new, and over 5 years, you're usually looking at that big early value drop, a higher insurance bill, and possibly a loan that isn't paid off yet when the warranty ends, balanced against very low repair costs and full coverage the whole time. Buy a 3-year-old certified used version of the same car, and you're usually looking at a noticeably lower price, a shorter remaining loan, and a bit more repair risk, balanced against a warranty that, if it's certified, may still cover you for much of that same time. Run the numbers on two genuinely similar cars, and the used option often ends up costing 20% to 40% less overall across 5 years, even after factoring in extra repairs, simply because the used buyer skipped paying full price during the years the car lost value the fastest. But here's a twist that flips this logic for certain buyers, because used isn't automatically the smarter choice in every case. If a car company is offering a real 0% or near 0% financing deal, the whole interest rate disadvantage of buying new disappears, since a used car loan at 9% or 10% now has to compete against a new car loan that costs nothing extra in interest. And if you're someone who plans to keep a car for 10 or 15 years instead of trading it in after 5, that early drop in value stops mattering as much, because losing value on paper only really costs you something when you eventually sell the car. A car you drive until it wears out never forces you to feel that loss. In that case, paying a bit more upfront for a newer car with fresher parts and more years of life left in it can genuinely be worth it. So the caveman instinct wasn't completely wrong. It was just answering the wrong question. Wanting the newest, cleanest, most untouched version of something is a perfectly good rule of thumb when you're picking fruit off a tree, because fruit doesn't come with a 5-year cost chart. It just goes bad. A car does come with a long, fairly predictable cost story, and the people who come out ahead aren't the ones who blindly trust their gut or completely ignore it. They're the ones who stop and ask which part of that story they're actually being asked to pay for. Sometimes the smart move really is to grab the shiny new axe, But most of the time, the smarter move is to let someone else take the first swing with it and buy it from them once it's already proven itself.